So first off, Chloe, can you give your book summary? Chloe is going to be covering major ideas and key points of the book. Mm.
Do you mind if I share it, or are you gonna share it?
You're sharing it. I allow you to share.
So this is my book summary. It's One Up on Wall Street by Peter Lynch. So this is three parts of the book Peter Lynch wrote. Preparing to invest, picking winners, and the long-term view. So preparing to invest. So basically I summed it up in this short paragraph. So I think in this part, Lynch emphasized some significant factors when investing in the stock market. Like one major factor he said was that professional brokers and advisors are sometimes overestimated. People think they're gonna earn all of the money because they have the brokers, and sometimes they won't. Advisors won't benefit you. He also stated that forecasting the future of stock market is really foolish because it's practically impossible. And he believed long-term investments are safer and have higher gains than short-term investments. Furthermore, he explained the benefits and differences between stocks and bonds. Bonds usually are safer but have lower returns. Um, when investing stocks, Lynch explained we're gonna learn we're gonna lose and gain money, but we have to be calm during times of losses. We can't just sell when we just lose some money. And then so part two is picking winners. So four ideas. I think the four ideas were discovering 10 baggers, six categories, the perfect stock, and stocks to avoid. So discovering 10 baggers is where he emphasized 10 baggers are usually near homes. For example, maybe the computer you're using right now might be a great stock. Like I'm using an Apple computer, and Apple is a famous and well-known stock. So the best place to begin looking for the 10 bagger is close to home. And then the second one is six categories. So he explains the six categories, which are slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. And then the third category is the perfect stock. Lynch believes the perfect stock is defined by following his 13 rules. Such rules include stocks having a special moat, a special thing about their stock that it's hard competitors to beat them, and stocks buying their own shares. So stocks he would avoid, the a single stock would be the hottest stock in the hottest industry. And he also would avoid stocks with cool brand names like Microsoft and the stocks that are known as the next something. So the long-term view, so these are three ideas. Design a portfolio, stupid things people say and want to sell stock. Designing a portfolio, basically Lynch emphasize to diversifying your portfolio and don't put all your eggs in one basket, which means divide your stocks into multiple different sectors. For example, don't buy our stocks in the technology sector and buy any many sectors because if one sector is doing really bad, you're not gonna lose all your money. And then stupid things people say, Lynch explains ridiculous theories people say. For example, some stock owners believe like cheap stocks such as $5 can lose them nothing, which is not true. Because if you buy a lot of cheap stocks and they're like really bad and bearish, you might lose like $1,000. Furthermore, portfolio owners consider bullish stocks can't go higher because the price is already so high, which is also not true. One example is Nvidia. It's like $900 and it keeps on going higher to like 1,000 and maybe more. So, and the third one is when to sell stock. So he gave categories for each one. He suggested for slow growers to sell stock when there are horrible acquisitions, market shares falling, etc. Stalwarts, no shares bought back from the company, expansion rate is falling. Besides silico, huge competition, growing costs. Fast growers, like if their earnings are falling, and then some of their key workers, like their CEO or executives, are leaving the company to other competitors. And turnarounds, are like when companies like in a massive amount of debt, and then asset plays like stocks access were not as well as expectations. So yeah, that's my summary. Thank you. Any questions? You can, if you have any questions, you can ask.
Hmm. Okay, Chloe, thank you so much for that detailed summary. Next, Isabella is gonna be presenting some like fun prompts and questions for chapters 1 to 5. Isabella, by the way, do you have like a document or a slideshow, or are you just gonna be talking about it?
I'm just gonna be talking.
Okay.
Yeah, because I'm on a phone, so I don't know how to present anything. But yeah. Okay. Hi guys. You just gonna hold it for me? Can you pass me the food? Hello. So, chapters 1 through 5. Let's talk about chapter 1 first. Basically, Peter starts off and he talks about his journey on becoming a successful like stock picker. So, I just wanted to talk about, or I wanted to ask you guys, how did Lynn Peters' early experiences? Wait a minute, guys. 你就直接问问题就行了。Can't. Peter's early experiences and observations, like his canning job and his educational background, or maybe his like family, how did that shape his approach to investing? Does anyone have an idea? I can repeat the question.
Also, Isabella, I think maybe it's just my internet, but I think you're lagging a little.
Anyone? Oh yeah, that's because I'm in the wild right now. I'm out camping.
Oh, yeah, she's cracking up a lot.
Hmm.
他们听不到啊。
听不到了。
They said I'm lagging.
那换地方，快停了。
Okay.
Oh, it's an test.
Well, yeah, I hear it fine, but they don't. So I don't know.
Mm. Oh yeah, by the way, Isabella, you're muted.
Can you hear me now better?
Yeah.
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 Okay. Okay. Wait a minute. I need to put this phone down. I'm in a little walk. Okay. So, let me just, if maybe I can Wait, sorry. Oh, there's a mosquito. Okay, okay. So, first question, how did Peter's early experiences shape his approach to investing? Like it could be his former job or family. Do you get the question, everyone?
I can like type the questions
Is
in
that
the
any-
chat. So
Okay.
把声音大点，话筒靠太远了，听不见。
Okay.
什么 type question？你讲，让那个他们给你 type 啊。你自己 type 太慢了。
oh wait, Lulu. Oh sorry. I maybe like I had a misunderstanding. I meant I could type like the question in the chat. But
Yeah,
Lulu-
you are in the computer. It's easier.
Okay.
Yeah, you just talk.
So,
but
first question, how did Peter's approach to investing?
what was Peter's approach? Oh wait, I did it in everyone.
靠近点，好吧。
No, and like how did his experience shape him? Like the experience he had with his former job, how did that lead him to, yeah. Does anyone have an idea at all? I can, remember his caddying job, like the people he worked for. Okay, Lulu. Yeah.
Can you guys hear me?
Yeah.
Yeah, I put in the chat because sometimes I have audio issues. When he was a caddy, he met a bunch of, well, not a lot of people. I guess like he met that higher up at Fidelity, which helped him to get started. The degree he took, when he was in college, I think like art and philosophy, he said that helped him pick good stocks since picking stocks was an art, not a science.
Okay. Yeah, good job. Thanks for answering. Yeah, that makes a lot of sense. The connection you made is great. Okay.
Yeah, but you guys should like speak up more, like participate more, like Lulu. Um, like if you can't hear the question or you didn't hear it clearly, you can just ask Isabella to repeat it or someone like to clarify. But you guys should participate more because it's like learning, right?
Yeah, guys, participate. Okay. So, yeah, I think that's very spot on. He also, another thing, it's not really that like good, but he also studied history in college, and that taught him probably a lot about like stock up and downs, like maybe the causes and the effects, and that probably led him to his belief that you need to research in order to be like a stock person. Okay, so first, does anyone know what oxymoron means? Oh, Lulu. Oh, okay, Max. Wait,
It's
sorry, because you went.
it essentially is an irony.
Yeah, okay, yeah, that makes sense.
Slash a
Okay.
paradox.
Yeah. It's putting like two contradictory words together, and it's like a paradox. Yeah. Some examples are like jumbo shrimp or deafening silence. But the thing is, Peter says that professional investors is a oxymoron like word because professional and investor are contradictory. I just thought that was pretty like, I don't know, it just explained Peter's whole investing thought process. So, can you how does Peter's perspective on Wall Street professionals influence his approach to investing? Chloe?
Like he thinks like Wall Street professionals are like overestimated, and they really they really won't like really benefit you all the time. So like he doesn't really, he thinks that you can invest by yourself. You don't need like a professional or an advisor to like do it for you, because sometimes they won't benefit you.
Yeah, really, really good. That's what I was thinking too. I wrote it down too. Okay. Oh my God. So he in this chapter, Peter talks about investing in gambling. Comparison between gambling and investing shape the way you look at risk in the stock market. Yeah, I'm gonna say it again. So how does Peter's like compare comparison between gambling and investing, like how does he explain the difference, and how would that lead him to his investing approach? Or oh, Max, sorry.
So essentially his logic is that without any proper research, without time and effort put into telling whether this stock is valuable or not, you are essentially doing a practice of gambling, because you're putting money on something that could go up, could go down. If you're not putting research or effort into that, you're completely relying on luck at this point. So you're like completely relying on the luck of whether or not it'll go up or down. So his whole idea is to invest in the way that most people would invest in houses. They're like, is it a corner lot? Does it have a larger lot? Et cetera, et cetera, et cetera. Does it have problem stuff? Like you should look at the stocks the same way you look at the house. Does it have like the potential? Does it have like all of these things and all of this effort put it, and when you put all those effort, then that is when you like become successful into that market.
Yeah, okay. Wow, that's a lot. Okay, good job. So chapter 4 is the mirror test, and Peter talks about self-reflection in this one, like financial position and your risk tolerance. So how would this approach to investing help a actually never mind. Never mind. I can't find it. Okay, never mind. So when you look at the mirror test, I want you guys to think about it and reflect on your own financial situation and investment goals. Like, what type of investor are you? Do you want to be a stock investor, someone that invests in bonds, or like equity funds, index funds? What do you want to do? Does anyone have an idea? Okay, Max.
Well, like nobody was sharing, but all right. So my whole plan overall. Wait, you're asking whether like our plan's correct?
Yeah,
Like,
your plans.
all right. Essentially, for me, it's just uh overall like stocks, yes, but you're like it's not like you're not doing a high value stocks like Amazon and things. Sure, they're more reliable. However, I also don't really do like a lot of speculation around these stocks. I did read this book last year, so some of my stocks are based off like local experiences of these shops, and it so far has performed okay, but I do plan to add a little bit more onto index funds that Bogo does recommend, because as a school person, the stock market closes at 4, so you cannot really watch it really. So you can't really do a ton of speculation or day trading or anything like that, because 9 out of 10 you're probably gonna lose money. So probably gonna keep it safe until maybe I go later I could start. That is maybe when I start doing a little bit more risky investments. But yeah, it's actually my
Okay.
option.
Yeah. Very detailed. Thank you very much. Okay. Livia.
I see myself investing in the index funds because like it's investing in stocks without actually investing in stocks. And but like when I'm older and not using my parents' money, then I'd probably start investing in actual stocks.
Okay. Wow. Very detailed plan too. Okay. I'm basically same too. And I don't think I'll do a lot of like dangerous stocks. But you know. Last chapter. So to predict the market, and he wants you to focus on individual stocks instead. So how does this thinking challenge common practices such as market timing? Let me say this again. So when trying to predict market movements, Peter says to focus on individual stocks instead. So how does this thinking challenge common investing practices?
Wait, can you repeat that again, Isabella?
Um, Lulu,
Oh, you know, she's never.
sure. Okay.
No, no, no.
How does Peter's thinking challenge like common investing practices? How is he different? How does he stand out? How is he unique? Do you want to follow him in the in his strategy? Olivia?
So Peter Lynch is like different because like he like tells you to like pick stocks, like find like companies around you or like that projects you might like and then investigate more. And honestly, I feel like his strategy is pretty good because like he picked out like some really great, like some amazing stocks. And also,
Okay.
he says don't to not trust a professional, like to not trust like a lot of professionals.
Yeah. Okay. Yeah. That basically, yeah, that summarizes it. Okay, good. Lulu, did you want to say something? Yeah, you raise your hand.
I was just gonna say that like a lot of people say that like you should just buy index funds or like follow portfolios or whatever, but like you should buy individual funds. I probably wouldn't follow his advice. I'd rather play it safe. Um, I think it's easier for him to say to like take these riskier, higher reward investments because he's using his company's money. But
Okay, okay, I see the difference. That's really cool. Very unique. Okay, thank you guys. I'm done presenting. Yeah.
Okay, thank you, Isabella,
Mhm.
for like these questions. So wait, now, I think Valencia prepared these questions, but since she isn't here now, I can like present them. So number one, what is the best place to look for 10 baggers, and what are some examples? Chloe? Well, you mentioned this in your presentation, so.
Yeah, so basically like you can find 10 baggers like around home, and maybe like it's in the book like he was impressed by Taco Bell because he ate like a taco, like maybe a restaurant you go to, maybe a product you buy, or one example like maybe a computer you use. Like right now I'm using an Apple computer, and Apple's like a pretty famous and I think Apple's a 10 bagger, I'm also sure.
Mm. Yeah, that's great, Chloe. That's actually exactly what I was about to say. But Max, do you have something you want to add on?
Yeah, so just like from personal experience, as I said, like I did read this book last year, so I did do some like personal beneath. So I find like what I personally thought were good stocks. And one of these was actually TJX, which is the company that owns TJ Maxx, TJ was Marshalls in there? Yeah, so anything like these resell uh companies, like these resell stores and stuff. And I was like, and a little while ago, like I was shopping at a TJ Maxx, and then I got a candy, which like and like saw some clothes, obviously, because that's what they sell usually. And I was like, okay, pretty nice. And so I invested about what around like one share into TJX, and so far it has about like an 18% return over 6 months, which is actually pretty decent considering.
Wow, that's so cool, Max. That's a really high return actually. But that's like a really interesting story. See, you applied what you learned from this book into your life and you made money. Well, yeah, probably. Well, you can see this book teaches important lessons, right? So, moving on to question number 2. What should you consider about the company when wanting to buy a stock because of one of their products? Like, what are some things you should consider about a company before you buy it? Because you think one of their products is really good. Livia?
I think that you should consider if like other people buy the products and other people think it's good, because if like you're the only one, if you're like in a minority of people who are getting it, then it's not gonna like earn as much money because not as much people are like buying their products, and it might end up like going bankrupt.
Yeah, Livia, that's a good take on it. Um, yeah, but that's great. But what if like everyone wants to buy their products? Like it's really popular.
Well, if everyone wants to buy their products, then you should probably like consider if it's actually a good option, because like it might be end up being like one of those hot stocks that like drops really fast. You should consider if like it would be good for like the long run.
Nice. Yeah. So that's right too. So Isabella, uh,
Yeah.
um,
Can you hear me?
Yeah.
Okay, so I wanted to say, um, first, I don't think I would buy it because even though everyone is buying it, I feel like the popularity would be at its very peak. So buying it would only result in me getting the worst of the stock because by then everyone is buying it. So I feel like, yeah, the peak is like over. Um, so yeah, but I do agree with Livia that it's probably one of those like hot stocks.
yeah, that's an interesting take on it too. So yeah, you two are both like you guys both like have great answers. Mm, So yeah, besides like considering about like if the company is a hot stock or not, mainly you should also consider like um how much the product's revenues compose like the total company's revenues. For example, if the product is only like one tiny product out of 500 or so different products that a company makes, then it might not have a big impact on the company's revenue. Even if the product generated a lot of revenue or money or like profit, it might not have a giant impact on the entire company's profit. So this like the income of the company might not be impacted that much. Mm. So number 3, what are the 6 general categories Peter Lynch classifies companies as? I'll give Chloe a chance to answer. So Chloe?
Slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays.
Yeah, nice. Mm, exactly. So, does anyone know the characteristics of each category or each category of companies? Isabella, can you name some characteristics?
What? Sorry.
Fine.
Oh,
What are some characteristics of stalwarts?
Give me a minute. Okay, give me a minute.
Okay. So while you're thinking, does anyone know some characteristics of stalwarts? Like Chloe?
Stocks are usually medium grower stocks
Also, it's okay.
are around 10
不是你不讲了，算了，你这信号不好，有机会让你
to 15% a year, and then maybe like some stalwarts or I'm not so sure. Some stocks are stalwarts, but not the characteristics.
Okay, that's amazing, Chloe. So Lulu, did you want to add on to her?
Stalwarts are usually really big, already established companies. I think one stalwart is Coca-Cola or Ralston Purina. They're like really big, so they don't make any big changes, but their stocks still go upwards just really slowly, I think.
Yeah, excellent, Lulu. So some characteristics of stalwarts are like stalwarts, they have like I think the book said 10 or 15 to 20% of earnings every year, around 15% or so. And the really important characteristic of stalwarts is that sometimes in like recessions or depressions they don't do as badly. Like they're normally pretty stable. For example, named I think McDonald's, Coca-Cola, and Ralston Purina, because like in like recessions they're still like going upwards, like sometimes just like sideways. Like they don't lose a lot of money when the market is bad. Oh, Isabella, did you want to add something? Okay. Okay. So, number 5, in chapter 9, Peter Lynch advises to avoid the hottest stocks in the hottest industries. So, why does he say that? And do you agree? Like, why not? Daniel?
The hottest stocks in the hottest industry means that like in the most popular industry that most people know about, in the most popular stock in the most popular industry is the one that people should avoid since it grows very fast, but then it'll drop at the same speed it grew.
Yeah, nice, Daniel. Do you agree with that?
Yeah.
I do.
Yeah. So, Max?
Alright, so he gave an example, I think, and it was there's the professional investor, quote unquote, which is the family's man, and then there's the lady, the wife essentially, and the man is constantly like hopping on these bandwagons to invest in the hottest stocks, and many of the times when the news comes out and when people start investing, it's already reached a cap, because there's going to be people, because when a company grows and then it's in the process of growing that it's grows its popularity. So by the time it reaches its height, that its peak of like value, that is usually when a lot of people bet. And then when it drops, then usually that is when it drops a lot more. So generally, like if you put your things in your hottest stocks, then it means that you put it in the highest point a lot of times, or in times it's already receding, which is also not great.
Yeah, that's amazing, Max. So yeah, as like Peter Lynch said, like a lot of like the hottest stocks, like they go upwards a lot. But like sometimes like they become kind of overinflated, and then like they can lose you a lot of money, especially when you buy at the top. For example, Nvidia. Okay, Nvidia like is still growing, right? But for a period of time, it was becoming so inflated. I think it had a PE of 240 once, like a PE of 240. And then, cause like a lot of people were buying it and it was becoming really hot stock. So then, of course, like the price went down for a while, like back to like slightly normal now. I think the PE is around 60 now. But yeah, like sometimes like stocks can be um like when, as in like Peter Lynch's cocktail theory, when everyone knows about the stock, sometimes it can become like um really overvalued, and like go down a lot. So does anyone have a, have another answer they want to share? Okay, Lulu.
Another part of like what he said, like to avoid the hottest industry, I feel like it's because if like that industry is really popular, there's going to be like a lot of competition. So like it's hard for any stocks like stand out too much because there's so much competition.
Oh yeah, Lulu. Yeah, that's another thing you touched on. Um, yeah, as you said, like in hot industries, there's a lot of competition and it's highly competitive. Yeah, that's excellent. Uh, Livia.
I have like a metaphor to add. Like when you get a sugar rush, you get like really high and hyper. That's when like the hottest stock is at its peak. But like then you get really low and then you fall asleep, and that's what happens to the stock. It goes bankrupt.
Oh yeah, that's a really good metaphor actually. It's kind of like a sugar rush, where, like you go up really quickly and then you crash down. Yeah, I hadn't thought about it that way, but yeah, it makes sense. Mm, so great. Mm, Now, moving on to question 6. Um, oh, and I would like to thank everybody for like participating so much in these questions. Um, yeah. So number 6, what qualities of stock does Lynch avoid? Like, what qualities does he think are negative and is like a major red flag or something? Chloe?
Like if the stock has like a really cool name, for example, it's like Microsoft or something like that. It's not that the Microsoft is really bad, it's just like it's really hot, and like he would avoid really hot stocks, and he would also avoid stocks that are known as the next something, like the next something of a company.
Yeah, great, Chloe. So yeah, that's one quality of a stock Lynch avoids, like um a really interesting name because he thinks it will attract more Wall Street investors. Honestly, do you guys agree with that? Because I feel like I don't really agree with that like 100%. Because like yeah, um a sometimes like an uninteresting name is pretty good, but honestly, I feel like it just depends on like how good the company is. But yeah, mm, that is one quality of a stock Lynch avoids. Mm, does anyone else? Oh, Max?
I also believe he did mention is that if it's a very small stock and it suddenly grows a lot and like it's like that it goes back to the point is it a hot stock? Like some of these small companies might be like uh fusion USB reactor goofy something something. And like it's just like it's not and like if the plans aren't proven and it's just like a really small stock that suddenly goes hot because of some new technology, it's very likely to fail too, because it's unproven, especially if it's a new technology sector.
Wait, Max. Yeah, that's something Lynch, like the author touched about in this book too. If a stock hasn't like actual performances or like earnings yet, but like it does like um some but like a lot of people are buying it because like, oh, it's some high technology stock and might have a lot of potential. Yeah, he usually avoids those stocks too. And we got Max. Oh, are
So
you?
like I just want to add on like a small example, and it's actually pretty funny, and it is Trump media. So the Trump media essentially has Truth Social, all of like the little social media company that Trump had. And the thing is, they have the company has 300 over $300 million of debt, and yet their earnings barely reach 1 million each year. So it's like, and yet it's overvalued to the point where I like also very reasonably right before the elections, it goes up to somewhere like $40, which is something like a large company like TJX would have like millions upon millions of dollars of like market profits and things, and then you just have this company that it just isn't proven, but it's just because it's like it's trying to support a campaign and stuff that it like that is like so overvalued that it's a little bit like that it doesn't even make sense.
Wow, I didn't know there was a company called Trump Media, and they actually have like stocks and everything. That's cool though. So that's a cool story, Max. So now let's move on to question number 7. What is the PE ratio and what does it determine in a stock? Does anyone know what the PE ratio is? Okay, Lulu.
It's a price to earnings ratio. The lower, like in general, the lower your PE ratio is, the better. But that's not always true. He talked about that in the book.
Yeah. 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 Cool, Lulu. So, Chloe, do you want to add on to that?
Yeah, so like as Lulu said, like the price to earnings ratio is basically um basically it tells whether a stock is overvalued. And if like for example hot stocks and growth really grow stocks like Tesla and Nvidia have like usually high PE ratios, but like not really growing stocks, and like slow growers have like usually lower PE ratios.
Okay. Interesting, Chloe. Great. Uh, Max.
Oh, yes. Wait, you're really on the PA ratio, right? I think I forgot to lower my hand, but all right. So the PA ratio, yeah. So just as said above, sometimes PA ratios are a good indication. This is like both personally speaking. Like usually, yes, lower is good, but for like things such as like Amazon or Google, like sometimes like PA ratio signifies that it's like it's already established there. It is like a company that is so widely used that it's sure it is overpriced, but it also means that it is somewhat stable. So yeah, my personal take.
Yeah, cool, Max. So just to wrap it up, the P ratio is like the price over earnings ratio. So it's often like a measure of how overpriced, underpriced, like fairly priced the stock is. And like sometimes like assuming that the earnings of the company stay the same, the P ratio is like a measure to see like how many years can the company earn back its like price if like the earnings stay constant. So overall, just like a measure to see how overpriced a stock is. So number 8, if a stock's current price is $60 and the earnings per share is about $6, what is the PE ratio and what does this mean about the company? Olivia? Mm.
Wait, me?
Mhm.
The PE ratio would be 10, and generally I think that it would be a good PE ratio, considering like the average is like 20 or 25, meaning that it's half the PE ratio, which is probably a lot better than if it was like the average PE ratio.
Yeah, excellent, Olivia. Um, so yeah, if a stock's current price is $60 and your earnings per share is about $60, is about $6, then the P ratio should be around 10. So this means like in assuming the stock's earnings like stay constant, then in 10 years the stock will earn back its price, which is $60, assuming like its earnings stay constant. So you usually that's a pretty good P ratio because as Lydia said, the market average is around 20-ish. But of course, for different industries, you have to look at like its P ratio also compared to its industry. For example, different industries have different P ratios. Um, so number 9, and the final question is, what are 5 basic ways a company can increase its earnings? Chloe?
So the 5 basic ways a company can increase earnings are reduce costs and raise their prices, like their items prices, and go into new sectors, markets, and sell more of its product in the own markets. And yeah.
Yeah, great, Chloe. That was about how I was gonna put it. So the 5 basic ways a company can increase its earnings is reduce costs, raise its prices, like expand into like new markets, just getting new countries or new segments or anything. They can sell more of its product, of course, obviously, or they can like close down some of like their um bad like bad operations or like, operations or factories that lose the money. Um, so yeah, Max, were you gonna add on to something?
I think he did mention, I think Pizza Hut and Domino's were in a trade war, and he did mention that trade wars are generally do affect a company negatively because like oh no, not a trade war, price war. So they're constantly reducing prices to get customer base. Sure, customer base for the long term could be possibly be good. However, in the short term, it's extremely risky for a company because they could potentially lose a lot of money as their net profit is going to decrease substantially. So he did say if a company exits out of a price war, that usually increases their earnings quite a bit.
Yeah, excellent, Max. I don't know if the book touched about Domino's and Pizza Hut, but yeah, price wars like you do usually like decrease a company's like uh earnings or like gross margins because like they have to be involved with like they have to lower their prices or like have to be involved in like competition with other companies. I think a while back, you know, Tesla, right? So Tesla was in like price wars or is in price wars with Chinese electric car manufacturers. Because like Chinese car manufacturers, they can like lower the price like more than Tesla's, little, and like it's around like the same products, you know. So then like Tesla is like losing some money, and like they had to, and then Tesla had to go into a price war with those Chinese electric vehicle companies. I think that's the main reason why we sold Tesla in the Hoperation fund investment portfolio because like its gross margin was going down and its like niche or moat as some people call it was like decreasing too. Mm. Okay, so now I'm gonna move on to the questions for chapter 11 to 15. Aurora made these, but since Aurora isn't here now, I can present them. Well, I think, wait, is Audrey here? Yeah, I think Audrey was supposed to present them, but since she's not here, I can present them. So for number 1 for chapter 11, what is the purpose of the 2-minute drill in Lynch's investment strategy? Oh wait, well, oh, sorry, I accidentally unshared my screen. I have no idea why. Okay, ah, okay, this will be good. Uh, Can you guys see my screen? Okay, sorry. So number 1, what sources of information does Peter Lynch recommend for gathering facts about a company? Olivia?
I wasn't gonna answer, but I was gonna say you skipped chapter 11. We're on
Oh,
chapter 12 now.
oh, sorry. Okay, sorry. So thanks for reminding me. Sorry, I didn't notice that. So question number 1, what is the purpose of the 2-minute drill in Lynch's investment strategy? Does anyone know what the 2-minute drill is about? Chloe?
I think it's kind of like the 2-minute drills, like it covers the reasons, like, and it tells yourself why you're interested in it, like what has to happen for the company to succeed, and then like the bad parts, and maybe like some things that stand and like its path to succeeding.
Yeah, that's great, Chloe. Does anyone want to add on to that? Okay, so as Chloe said, the 2-minute drill is like in Lynch's investment strategy. It's basically for Lynch to like just like see or like provide like information to like why he's buying the company or why he thinks the company is good. So usually like it includes like what his reasons for its buying a company, potential things the company has to do to like live up to that, or like for him to buy it, etc., etc. So he can tell like whether or not so he can like tell himself, like to tell whether or not he should like invest in a company. So what are some essential things of a company that an investor should focus on? Like, fine, this is kind of like an open-ended question. What are some essential things of a company you would focus on? Because there's a lot actually. Does anyone want to answer? Or Chloe?
I would like look through the fundamentals and then see their products and really see like are they expanding anything, and like what it do they have a moat or anything like that, like maybe they're going to expand with a new company, like the news of the company, like expansion, all of that. And I would see the company's management, and then I would see whether like it's really hot right now, and then like whether it's really high and hot right now and everyone's wanting to buy it. Really, yeah.
Yeah, amazing, Chloe. Those are some of really important things I would also look for, and like if I were focusing on a company. Livia?
First I would see like if the company like buys back its own shares because then it thinks that it will do well and it probably will do well. I'd also like to look at like if they're having like competitors and like if they're like winning or beating their winning or losing to their competitors. And like what kind of management they have because nobody likes bad management and like their like product because if they don't have a good product, then why should I buy their stock? It might not be good too. And their earnings compared to how much they spend to the product, because if they are selling at a loss, then they're losing money, meaning that their stock might not be doing so well and might like do the same as that. And also like their PE ratio.
Amazing, Livia. Yeah, those are all really important things I would look for if I were investing in a company. So yeah, I would look at its basic fundamentals, its ROICs, its P ratios, etc. etc. I would look at if it has like a moat or niche. I would look at if it has good management or not. Insider buying, like sometimes like if a company is good, of course, then like its insiders, like its management, is gonna buy a lot of shares of the company stock. I'll look at its different fundamentals, its products, different like market changes sometimes. Yeah. So moving on to chapter 12. What sources of information does Peter Lynch recommend for gathering facts about a company? Okay, Chloe?
Like there's companies always give out their papers to investors, like their earnings report and all of that. Like if they're buying new shares and really a lot of important stuff.
Yeah, great, Chloe. Livia?
I think he also said that you could like go to the company and like gather facts because what better to get facts about a company from the company itself.
Yeah, good, Livia. Yeah, he said that too. Um, Yeah, so some sources of information Peter Lynch recommends for gathering facts about a company, like as Livia said, you can like go to a company, of course, but you can also go like to see its like quarterly or annually reports, like its financial reports and financial statements and stuff, and mm, or like sometimes like he also said you can call your stockbroker if you have like an actual like person for a stockbroker. Um, because stockbrokers like they can like gather different sources of different pieces of information for you. Question number 2: how can investors effectively use a company's annual report and financials? Oh wait, okay. How can investors effectively use the company's annual report and financial statements in their research? Speaking of which, does anyone have any questions so far about? Chloe?
Like they can look whether the company has debt and their gross margin, growth rate, the revenue, profits, and compare it to last quarter. Really, and they can see whether they are making new products, EPS, and a lot of like things. Because if you don't look at the financial statements, you might be missing a lot like important information. Like maybe the company is really in debt, maybe the product they're selling hasn't been up to expectation, and it might like it might the stock might go down after like because they have like bad financial reports and bad earnings.
Yeah, amazing. Amazing, Chloe. So yeah, you can find a lot of stuff in a company's annual report. So moving on to chapter 13. What are some key financial ratios that Lynch focuses on when analyzing a company? Actually, I think we're getting a little short in time here, so I can just like skip something. Okay, fine. Question number 1: what are some of the key financial ratios that Lynch focuses on when analyzing a company? Or and like what are some financial ratios you think are pretty important too? You can find this in chapter 13, by the way. Chloe?
Like PE, free cash flow ratio, and then like ROI and yeah, and probably maybe like a few smaller one like PS, like SMA 200. I'm not so sure that he like said that one, but I think that he said that one, but I think those are pretty important.
Yeah, cool, Chloe. Does anyone else have any key financial ratios that Lynch mentioned that you think are really good to analyze a company? Okay, well, some financial ratios are like well, as he said, like the P ratios, of course, PS ratios, but there's also its cash position, like how much cash it has after like accounting for all of its debts and stuff. It can like sometimes help you when you're looking for asset plays. Of course, there's also like really important things like ROIs, ROCs, its PB value, hidden assets, etc. Oh, and it's free cash flow too. Does anyone know what free cash flow is? Okay, well, ah, okay. So basically, free cash flow is like the cash a company has left over after like accounting for its like costs and stuff, basically. So this is like what makes a difference between like two companies. Like if they have the same revenue, but like if they have to like they have much different like really different costs or anything, well, free cash flow is like basically can tell you how much cash a company actually makes, and it's a really good like evaluator for if a company is good or not. So number 5, why does Lynch emphasize understanding the company's earnings growth rate? Okay, does anyone know what the company's earnings growth rate is? Hold on. Okay, wait, Max, are you raising your hand, by the way? Okay, I'll just call him Max then. Sorry, Chloe, but like,
Alright, so essentially, earnings growth rate is essentially the rate of growth of its net revenue from its earnings slash profits of a company. And it's just especially important because it shows that if is the company essentially growing or not.
yeah, excellent, Max. So basically, a company's earnings growth rate is like how if its earnings are growing, like if its earnings are constant, that means like the company, like while it's like earning something, like it isn't exactly expanding, like its earnings growth rate like shows like how much like a company's earnings are actually growing. So does anyone know why Lynch emphasizes, or like why the author emphasizes understanding the company's earnings growth rate? Chloe?
I'm not so sure if my answer is correct, but I think he really emphasized it because, like, if a company's earnings growth rate isn't very high, there might be other competitors in their sector that's gonna be like might gonna take over, and like if there's really low, they might can't really compete with their competitors, and earnings growth rate also matters, like because yeah, really I think it matters because like to stay strong so like their competitors won't like take over their company.
Cool, Chloe, that's great. So yeah, a company's earnings like growth rate is pretty important too, because like it shows like how much your company is like growing basically. And okay, I'm just gonna pick like 1 or 2 questions for chapter 14. Okay, number 1, why is it important to recheck a stock or company's earnings? Chloe?
Because if the company's earnings is really bad compared to the quarter you bought it, maybe the quarter you bought it, it was like really high, like 200%, but if, like maybe a year later when it hits quarter one and it's like 10% growth rate, then like the potential is a little like smaller, and it's really important because the potential in the future, if like the earnings growth rate is really low, the stock might fall or won't grow that much.
Yeah, excellent, Chloe. So it's like important to recheck a stock or company's earnings, because like just in case like some fundamentals in the company changes, and of course like if you're gonna buy a stock, you might as well like do research and like keep like being updated on a company. So moving on to chapter 15. Mm, there's a final checklist in chapter 15, so I can give you guys like 1 minute to skim over it. But if you have already, what did you learn most from the final checklist? Okay, fine. Um, it's at the end, I think. There's like some pointers like for this section. Lulu?
I guess for like stalwarts, check for possible diversification where it goes bad, like diversifications that may reduce earnings in the future. Because like from what I've read, it seems like that happens a lot. And then like also for like fast growers, what was I gonna say? Oh right. You have to see if the product that's supposed to be like that you really like is like a major part of the company's business. Like for example, like that example with like the Hanes like egg legging things versus like the Pampers diaper thing for Procter and Gamble.
Oh yeah. Yeah, you remember that. So, yeah. Um, so there's many things you can learn from the final checklist. I think you got it from the stock, for each like category of stocks. Um, so yeah, does anyone else have something they want to add on to that? Okay, so moving on to question number 3, what do you think is the most important key idea of the book so far? At the end of the chapter, I think they the author listed some important key ideas, but what do you think is the most important key ideas you learned from this book? And this is like an open-ended question, really. It just depends on like what you think like is the most important thing you learn. Chloe?
Really, the most important thing I learned is like kind of like when you invest in stocks, just like really trust in yourself. And like if it falls, it's fine because like you're working through the long-term view. It's probably gonna go back up again. And really, like you don't have to have all the professions of vibers. There's just like trust in yourself when you buy the stocks. Use the knowledge that you know and buy if you think it has potential and you have faith in it. Really.
Yeah, excellent, Chloe. Olivia?
I learned a lot of important ideas, but one of them was to expect the unexpected because things can turn around really fast and you have to be ready for that or else you might lose a ton of money.
Yeah, amazing, Olivia. That's really interesting. Max?
Like from this book and from like other books, like a lot, like I think like the most important thing is don't trust other people when you're regarding investment in stocks. Trust your own self and trust the research that you found, that like the statistical, the unbiased and unopinion view of a company from in terms of numbers. And that is by far probably the most important because your own decision is likely as good as any other person's. And for your own portfolio, that it probably is better than most others.
Mm. Yeah, that's great, Max. I like totally agree with that, right? When you like are choosing your own investment portfolio, like maybe some other people have good advice, like sometimes you can keep an open mind and like listen to them, but the most important thing is to still like trust yourself and like if someone is giving you a tip, you should probably like do some research before you like invest in a company. And now, since I really am getting too late, uh, Livia, now let's move on to chapters 16 to 20. Livia, it's your time to present. Take the stage or whatever.
Okay, I'm also gonna be skipping a few questions because um it will kind of take like really long if I did all of them. Question one, what is one way to minimize downside risk? There are probably many. So this is an open-ended question, I guess. You can just like raise your hand. Okay, since no one is answering, I'm gonna answer this one myself. One way I found that you could use to like minimize downside risk is like putting your eggs in like different baskets because if you put all of them in one basket, then if you were to drop it, if you were to like drop the basket, which means like if the stock were to go like down, then you'd lose all your eggs or money. Question two is an open-ended question. How do you expect your stock portfolio to change as you age? Chloe.
Yeah.
Probably when I grow older, I'm gonna buy more bonds, but like right now, I really don't need to worry about it because like honestly, there's not like a lot of risk since I'm like a kid. So I can buy like really a lot of stocks, but when I grow older, there might be more risk. I'm looking forward to retirement, so maybe like more bonds.
Okay, Olivia.
Oh, sorry. I don't know how to raise my hand, but whatever. Um, so honestly, because right now I'm pretty young, I would like more invest in like slightly riskier stocks, and I would like try to like invest like my like basically all of my money in stocks. in like an investment portfolio. But when I grow older, I might want to like minimize my risk a little. Like when I grow like 30, 20 years old, I guess. Because right now I'm still experimenting, right? But once I grow like older, I might want to minimize my risk a little and like maybe pick like slightly less riskier stocks and yeah.
I like your take on it. I'd probably do the same. Max?
Um, so one way to minimize downside risk, as I think a lot of people have said, is to diversify your portfolio. A diversification of a portfolio of bond stocks, ETFs, and other things does mean that in any sector, and yes, and doing it all sectors, if you have any sector or any area that goes down at any point, as long as it's not like a recession where almost everything like crashes, usually it means that like the majority of sectors stay stable or growing while maybe one or two do go down. If you do not diversify, it does really mean that you have the chances of being the one which loses all the money or a good portion of money from uh not as much of a diversified portfolio. As a question too, most probably my stock portfolio will change probably with a little bit more risky as contrary to a lot of people. It's because, as I've said previously, the market does close at 4 o'clock, 4 p.m. each night. And as currently I'm in school. So that means that with the driving time, I'm not able to trade daily. I'm not able to look at the stock be like, oh, it's suddenly dropping, or oh, it's suddenly growing, or oh, this research means this stock could be good. So all of this is like in when the market closes, or in like essentially in times where I cannot actively like control my stocks as well. But however, when I do age older, it does mean that I do have more leverage over my stocks. Question three, do you think that the price of stock usually relates to how the company is doing or vice versa? No, definitely not the case at all. The price of stock is not at all related to how well a company is doing for certain scenarios. Yes, a majority of the time it does mean that the company is doing well. However, as I said, in Trump media, it's like even an articles read about written about this. It goes up when there's no apparent change. It goes bumpy up and down, and when it's good news, it doesn't grow. When it's bad news, it doesn't drop. So the thing is like and the whole thing is Trump media isn't based off its profits. It's not based off how well the company is performing because it performs terribly. It has like 300 million debt while only gaining like less than a million a year, actually a quarter. So it obviously is already great. However, its whole stock price is based off like just people trying to fund Trump's campaign, which in turn drives, so they have a purposefully drive the stock up in times before the elections. And you can literally look at the graph and it would be this case. So it does usually relate, but not always. And in many scenarios, it is based on the consumer view of these hot stocks, and or it's just for other reasons that are similar to Trump media. So yeah, that's my personal take.
All three of your answers were actually great. Your what's it called? Um, thing, I forgot what it was called, sorry. With the Trump media, it's a really good example. Yeah, that was what it was called, sorry. Okay, I think we're gonna move on to chapter 17 now. Okay, chapter 17, question 4. So on pages 245 and 246, there are two listed periods when bargains can be found. What are those? Is anyone gonna answer? Are you like looking at your book?
Oh, I was.
Okay, what's your take?
Wait, I forgot. Where are you
So-
Okay, you're
Wait, what?
I'm sorry, where are you again? Like, what question is this?
This is question 4.
Okay. What do Well, so I mean, I think bargains could be found during, it says bargains can be found during the holiday period, October to December.
Wait, what did you say? Sorry.
It says the two times where
Very good. Olivia?
So 2 periods where you can find good bargains is like when like most like people like sell taxes like at the end of the year because like the stock market can drop, and then like
October to December.
it's like a good time to buy stocks. And another one is like of course like when like the stock market drops sometimes like unreasonably because like if like a company's fundamentals are still good, then it might be like a but it just drops like usually or maybe like sometimes during recessions or like depressions or something every few years, sometimes when the stock market goes down a lot you can buy it, so it's like a good bargain. I'm sorry, by the way.
You're fine. Okay,
It's in October to December and year times recessions.
Yep. Okay, we're gonna skip question 5. So question 6. There are advice on where to sell, when to sell a stock. Is there anything else you would like to add, or are there anything that like you don't agree with? And if you don't agree with any of it, why? This is an open-ended question. Okay, this is kind of awkward. I guess we can move on. Okay, question 7. So question 18 is all about like stock advice and like statements. Have you ever heard or said any of those statements, Chloe?
I mean, I feel like I said them before. Like I don't know, like I think what about like the video when it was like around $900, I thought it couldn't really grow anymore because like well I mean like I kind of thought you couldn't I think I kind of thought it couldn't grow anymore because it was already this high and it might like reach the top. And like I also like when I bought like MGY, it was like $25, $20 or something like that. And then I was like, if I lose any money, it's not gonna be any big deal because like it's only $20, honestly. But like if I bought more of that stock, like I don't know, 1,000, and I lost all of it, it would be like a lot of money.
Wait, I disagree though when like you said like a stock can go higher because like yeah, Peter Lynch said that like um like sometimes like when someone says a stock is so high, it can't go higher. Sometimes that's not true, but sometimes it is true. For example, like it's like there's only so many hamburgers you can sell, or there's only from McDonald's. So there's only so much a company can do sometimes. So sometimes like if a company's like price goes up a lot, then like sometimes it's just not really realistic. If like the if you think it's gonna keep on going higher. And Peter Lynch, the author, did say that previously, in like a few chapters before, though.
Mhm.
But yeah. So
Roth-
I one time I heard one time I heard my mom say something about the stocks going down and how that meant that we should buy stocks because they're definitely going to go up. They did indeed end up going up. However, that does not always happen.
That's true. I think we're gonna skip question 8. Okay, moving on. In the case of insult added to injury, would you personally sell if your stock is low, even though you thought it was short, or would you continue to hold it because you still believe that it will continue to go up? Chloe?
I would not sell because in a long-term view, really usually stocks will bounce up, and if I think it has potential, like when one of my stocks dropped like around $150, I thought to sell it, but I think because it was like I was losing money on it, but then it grew back to like grew back to even more. So I wouldn't like sell it if you think it has potential.
Mhm. I think I would sell it though because I get really wimpy. Max?
Personally speaking, it depends on a lot of things. Does it have any potential? If it's like bankrupt, well then, well, might as well just sell it. It's probably not gonna. If it's fine for chapter 11, sure. But most likely it's just gone. It's just done. It's gone. It's not coming back. But if it's like okay, so it just dropped recently. Maybe the products were good, but like the fundamentals or like the whole plan overall is decent. Like, just might as well hold it because it still has a chance, and this could also potentially be a good spot to buy a little bit more of the stock. Just like it just all depends on the scenario.
Yeah, it probably does. Okay, question 10. What is your opinion on shorting a stock? Do you think it's like criminal because like you're using someone else's money, or do you think that it is completely normal? Would anyone like to add something?
Uh, honestly, I don't feel like shorting a stock isn't exactly criminal. It's just like a way to like it's kind of like investing, right? Um, it's basically to me like the same as normal investing. So I don't really have any strong feelings about shorting the stock. But yeah.
Okay. I think, oh wait, can you go back? I'd like to add something to my own question.
Okay, there.
So shorting a stock is like using someone else's money so you can gain money. I think that it's both like you're using someone else's money, so that's technically stealing, but they end up getting their money back. Just they kind of lost some of it because the stock went down. Okay, moving on.
Well, I mean, like they agreed to it.
Yeah, I guess.
Okay. Okay.
Okay, what does LBO stand for and what does it mean? Max?
Uh, so it so I think it was like it's like you're buying out like a company, so essentially like you're just like process of like it's just essentially just like buying another company, but like you're not using like cash, like you're not using like solid cash, you're like using I think uh stuff like loans and bonds, like rather than like this like solid like liquefiable cash. And yeah.
Okay, that was pretty similar to what my notes said. So LBO stands for leverage buyout. And my notes say that it's the purchase of a controlling share in a company by its management using outside capital. It's kind of confusing if you ask me. Question 12. What is the Monday effect? Does anyone know what it is?
Isn't it like when there was a big drop on the stock? Like on the Monday effect, like there was a big drop on the stock.
Kind of, I guess. What I took was
Like,
that
like sorry, my bad. But like Peter Lynch says like and that by Monday morning you're ready to sell all your stocks because it's kind of the Monday effect, which makes people like sell their stocks because they're like worried.
yeah, because like I don't think the market is open on Saturday or Sunday, so they can't really like check what it is. They kind of like freak out and have no idea what is happening, so they just want to get rid of everything. I think that's all. Yeah.
Okay.
Thank
So
you.
yeah, thank you everybody for like uh, thank you Chloe, Isabella, or where is Isabella? And Livia for like making these questions and presenting. Um and I would like to thank Aurora and Valencia too for taking the time to make these questions. And overall, thank you everybody for coming to this reading club. I really hope you guys learned a lot from this book. Speaking of which, did you guys like this book better or the previous book better?
This
Uh
this one.
take the previous book was repeating itself a lot. Not necessarily a bad thing, but it has like
The
one
previous book repeated like how you should buy mutual funds, y'all, and not buy not that. The previous book repeated like how you should buy index. Wait, what?
yeah, index fund. It was like
Oh, index funds and not mutual funds. Repeated
well,
after like 5 chapters.
I mean, like everybody has their own opinions, and we probably wanted to emphasize that.
that was
Like,
definitely like a lot
I
more
think
interesting.
this one did offer a lot more like personal examples.
yeah.
Yeah, this one was by far more interesting to read. But I mean, yeah.
Oh, which book do you agree with the most? Like both have
Mm,
like the evidence.
I mean, both of us do have evidence, but like, I do see that Peter Lynch and Bogo do have a point. Like, they just have their point, like different viewpoints. Like, Peter Lynch essentially is like, his viewpoint is like all of them want like something like stable, not speculation. However, his Peter's viewpoint is to research more, and you could. While Bogo's like you can never beat the market, never ever 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 ever. So always just put it in index funds and wait your whole life out. But uh, I mean you could like implement like a little bit of both, I guess.
Yeah, they both have the points on. Like they both share the same thing. Like most investors, like they kind of like fail at being the market, but like they have like different ways of like taking that information and like putting their own opinions in it, right? Peter Lynch says like you can't beat the market. It's really possible. Like Bogle, he's like it's like there's not that much of a probability of beating the market, so he suggests you buy index fund. But yeah, so overall, this is this concludes our second meeting with the reading club. Next meeting we will read AI 2041. You guys might like this. It's mostly just short stories. It's about this guy called Kai Fu Lee. He's like a really influential figure in China. He's like a really influential figure in China. Like he's like basically the AI seer of China or something. Well, I think he's Taiwan. And he has like this company where he invests in like AI startups, and he's invested in like 10 like he's invested in startups that turned out to be like 10 million or like sometimes even $1 billion startups. And like he was in like lots of interviews and stuff too for AI and stuff. So he's like, yeah, a really influential figure in AI. So yeah, I think he's Taiwanese. Yeah. Well, anyways, he wrote this book, and it's just like some short stories about how AI might be applied for in the future. And yeah, I think you guys might enjoy it. So that's the next book we're reading for the next meeting. And overall, yeah, this concludes this reading club. Does anyone have any questions? Okay, so thank you guys all for coming and taking the time here. I know we kind of went over time, kinda, yeah. But overall, thank you guys and bye.
Bye.
Hi, thank you.
Bye bye.
Oh, thank you.